Well, welcome back, everyone, as we continue our coverage here on the future of development finance. I'm again Raj Kumar, President and Editor-in-Chief of Devex, and delighted to be joined by Sir Ronald Cohen. Nice to see you, Ronnie. Thank you for taking time to be with all of us today. People know you for many reasons. You had a notable career as a venture capitalist, and you've really been a leader in the impact investing space, thinking about social impact and how you measure it. You've got the book over your shoulder there called Impact that you're an author of that people should read. And you chair the Global Steering Group on impact investing and on so many other issues you've really been pushing. So I want to just begin with what I think a lot of people in the audience here are focused on, and that is there are trillions of dollars sitting on the sidelines, some of it earning negative yields, right? And yet there's trillions of dollars of need in low and middle income countries to invest in things like health and education, sustainable infrastructure. You're really working to reimagine capitalism. And I wonder if you can connect the dots there. How is reimagining capitalism going to help drive some of that investment to where it's actually desperately needed?
Well, Raj, first of all, let me say how great a pleasure it is to share the platform with you again after several years and to be here with the Devex community. It seems to me that if we want finance to be the lever that can really shift the world, then we need to give it a fulcrum. And the fulcrum is impact transparency. When you begin to show the impacts that companies are achieving through their sales, through their investments on people and planet, you begin to create a competition between companies to deliver greater impact as well as greater profit. And I am hopeful that impact accounting will come in the next 3 to 5 years, that it will become mandatory for companies to publish impact-weighted accounts. And that will enable us to see what percentages of sales of different countries are addressing populations in emerging countries, and to look at where the investments of companies are going. Now, in addition to that, there's a very exciting new development occurring. There is a pool today of $1.5 trillion of green, social, and sustainable bonds. And within that 1.5 trillion, 10% is going to sustainability-linked bonds. What does that mean? It means that the issuer of the bond, the company issuing the bond, say Novartis, which raised 1.8 billion euros about a year ago, sees its interest rate fall if its products reach a certain number of vulnerable people. It means that Enel, the Italian electricity utility, which has issued $7 billion of sustainability-linked bonds, sees its interest rate fall if it reaches environmental targets that have been preset. And so I think, Raj, we need to focus on these types of incentives now to create competition, take advantage of competition between companies, and shift our mainstream markets to addressing the challenges in developing countries.
Yeah, that's a great point. You're trying to create a market mechanism, right, where better behavior leads to cheaper cost of capital or more investment. And I guess I wonder, there's so much demand now for these kinds of products. ESG-linked assets are a third of assets under management. But how much of it is real? I mean, given that you are very focused on the accountability side of this and measuring it, how much of what we see is actually real? And if we get to the impact-weighted measurements you want to have, if the tide comes out, will it appear that many of these funds that call themselves ESG, or these bonds even, that appear to be accurately linked to impact, won't be in the end?
Well, as companies have begun to realize that impact helps them attract customers and talent and investors, all sorts of companies are making claims now which aren't always defensible. So greenwashing is rife. Now, in the world of impact investment proper, which today I believe must be over $1 trillion pool, you have metrics, clear metrics for measuring your impact. So you can safely assume that the impact has been targeted properly and has been verified. But in ESG, that's not the case, and that's why I've put so much effort through the initiative at Harvard, the Impact Weighted Accounts Initiative, to show how an impact accounting framework can actually be implemented. And when you begin to look at the data that we provide on thousands of companies now, on their environmental impact in dollar terms, on the social cost of lack of diversity, again in dollar terms, differences in gender pay, and so on, you begin to realize that impact accounting is really the tool that's going to shift us from economies that just optimize risk and return and risk, return, and impact. But we need governments to mandate consistent metrics and consistent paths to monetization. We need to create generally accepted impact principles alongside the gap principles that we have. And so I am hopeful that governments will now begin to move in that direction. We see the SEC pushing for climate transparency. We see the EU and the SEC focusing on corporates' climate transparency. We see the EU focusing on the transparency of funds with regard to impact. We have to unite social and climate impacts. You can't solve one without having repercussions on the other. So you need to solve for both simultaneously. And we need to get governments to understand that it's the way for them to bring companies and investors alongside them in achieving their goals. So if we think in terms of emerging markets, this transparency would give investors and talent and consumers the ability to make decisions that impact emerging countries in the way they desire.
And so fundamentally, it sounds like what you're saying is governments, and we have governments as part of this conference following this conversation, their role primarily is to ensure that the companies in their jurisdiction must be transparent about their impact on environment, on society, on governance. And then the markets will have mechanisms to reward those companies that do well and to hurt those companies that do badly on those metrics. But fundamentally, the regulatory role here is to push for transparency. Is that right? Is that what you're saying?
Absolutely.
And then,
governments have huge allies in investors who can help change the behavior of companies, which are, after all, the entities creating social issues and climate issues. Governments aren't creating them, companies are creating them. And so if governments bring this transparency, they bring trillions of dollars alongside them in trying to achieve their goals.
And then just to think this through for a moment, because again, we've got people following this that would probably want to get into the weeds with you on how this measurement really works. There's so many different approaches out there to measure impact. And the one that you've taken up with your colleagues at Harvard in this project is to say, well, let's actually put a dollar amount. So if we know a company has, ExxonMobil has generated X billion dollars in profit, well, let's take away from that, Y billion in costs that they've created for the world through carbon emissions. And that's relatively straightforward, and not easy, but relatively straightforward with carbon because you can measure the price. How are you going to do that for the more complex social issues? How will you actually, and do you have confidence you can get to really solid measures on this?
So we've done it, and you're all encouraged to go to the HBS, Harvard Business School, IWA, Impact Weighted Accounts site, and look at the 17 reports that show how this has been done, but you can also look at these data sets of thousands of companies. In the case of an issue like diversity, what we've done, and big data and computing have made this possible, is compare the demographics outside of a facility, an Apple facility, say, with the demographics within it. And then to ascribe salary levels to the missing people from different communities. They can be gender communities, ethnic communities, and so on. And that gives you a figure which is a measure of the cost to that community of not having been employed. So if you look at a company like Apple, with a $7 billion US wage bill, there's a $2 billion negative charge for lack of diversity. That actually compares quite favorably with Intel, which is much smaller and has a similar negative charge. But it compares less favorably with Costco, which has twice the number of employees of Apple, but a charge of about $1 billion. And you can see, Raj, how bringing this transparency begins to pressure companies to compete with one another. Nobody wants to be the worst company on the block, whether it's the dirtiest company or the least equal company.
Yeah, and eventually when they get that moniker of being the dirtiest company or the least equal, it does have some impact in the market, especially given how consumers and investors are behaving today. I think what a lot of people in this space worry about is these are big corporations you're talking about. These are large public companies. But when will this kind of ESG work connect more to the SDG work in the low and middle income countries? Is there some tipping point that we're waiting for that will help to make this connection more direct?
I think impact accounting enables us to connect to every single SDG. Certainly, that's what we've done at Harvard. But on the first point you made, what's going to drive this impact transparency is the fact that we already see a correlation between higher levels of pollution and lower stock market valuation. So as you were suggesting, Raj, the weight of the ESG money has tilted the scales against companies that are polluting more heavily. What that says is impact data has become stock price sensitive, and therefore regulators have to step in to ensure that every investor has access to the same information on a consistent, comparable, verified basis. That's why I say it's inevitable. It's a foregone conclusion that we're going to get to impact accounting.
So thinking ahead a little bit, I just wonder, will going to this era when companies have to, release their impact measures and stock markets are judging them on that, do you think that will have maybe an influence on public companies and their corporate responsibility programs, on their philanthropies, their foundations? Right now it's very common for major corporations to have a foundation, and that foundation maybe tries to address diversity questions or deal with constituencies that they care about. But if these things are really baked into their business results, then won't there be no need for companies to maintain their own private foundation or their own CSR initiative? What do you think is the future of those kinds of activities?
So I think they're complementary. In my book, Impact, I talk about how this notion of impact is really disrupting the models of investment, of business, of entrepreneurship, and of philanthropy, as well as government, by the way. I think philanthropy is shifting now to measuring more outcomes that are created instead of just measuring activities that you are funding. We see it in the development space. Pay for success is a very good way to have service delivery organizations focus on hitting targets in the best possible way. And so I'm hopeful that the charitable activities of companies will be analyzed in much greater detail, and that it will therefore prevent the sort of marketing-led philanthropy which is designed to enhance the relationships or the brands of a company, to activities that actually improve lives say in the supply chain of a food company, by improving the livelihood of farmers through philanthropic donations. But the name of the game isn't to transform philanthropy, because philanthropy is just a $3 to $5 trillion dollar pool across the world in comparison with 200 to 300 trillion in financial markets. The name of the game is to shift our decision making as investors and businesses from just risk and return to risk, return, and impact. And for that, impact needs to be measured reliably.
And that is the fundamental issue. And I thank you for bringing that to the forum today, because you're right. It cuts across so many of the players that are represented in our conference here and their work, that results will matter. And people are paying attention to those metrics. And in the end, markets are going to determine, based on those impacts, what goes up and what goes down. And that is a really important message from you, Ronnie. Thank you for the work you're doing on this, and for taking the time to be with all of us here at our Future Development Finance event. Thank you.
Thank you. My great pleasure. Power to your elbows.